Josh, good to see you. I'm glad we get a chance to talk today. We're going to talk through 3 financial planning and investment opportunities in a down market. So, of course, as most of us know already, stocks recently closed out their worst quarter since 2022. The S&P 500 and the Nasdaq logged their worst performance since 2022. So, before we get into how to take advantage of the market right now, I do want to talk through what we're seeing, which is something you and I have talked before, known as concentration risk. 80% of the market's movements due to only 10 stocks. To see what that looks like in another light, we take a look at the S&P 500's 1-month performance. So Josh, when we see this much red on the board, what should we keep in mind?
Well, what you should keep in mind is the hard part is the S&P 500 is considered by most a diversified portfolio, but what we're seeing is 82% of the movement is done through 10 stocks.
Yeah.
And those 10 stocks move very quickly, both in the up and down direction. And so that's that concentration risk we've been talking about, where you're just really not getting as diversified as you thought, because you put $100 in the S&P 500. Well, 70 of it is going to 7 to 10 stocks, and 30 of it's going to the other 490 stocks. So you're overweight in those big companies.
Right.
And then that's what causes the market to move faster, both in the up and down direction, and causes this concentration risk we're seeing.
Right. And just one more stat to show everybody, the Magnificent Seven, sometimes Magnificent 10, they lost $2 trillion since the start of the year. So, I mean, that's just a handful of stocks moving the market.
Right. And during that period of time, that's most of the losses.
Right. Exactly.
A large percentage of the losses that have happened.
Yeah.
And that's where a true diversified portfolio makes more sense than just the S&P 500, and also a portfolio that's built for volatility, because volatility is going to happen. We cannot control what the stock market does. As much as we would like to, it's not possible, but we can control how we react to it. And if there's opportunities, we can take advantage of those opportunities or manage through them. But the last thing you want to do is be reactionary during a down market. You have to be proactive, not reactive.
Right. So let's talk through those opportunities. And the first one is put your cash to work. It might feel better to kind of hoard your cash in the mattress right now, but that really does compromise your opportunity to build long-term wealth.
Yeah, it's the big rule from Warren Buffett: buy low, sell high.
Yep.
Well, when do you buy low? You buy low in painful times. You feel like it would be safe to just keep that cash wherever you have it, but that's not what gets you the best value. What gets you the best value is buying during these bad times, because we're essentially buying the stock market on sale, because you're owning the same stocks as you did 2 months ago, only you're paying 20-30% less for them.
Wasn't it Rothschild who said the best time to invest is when there's blood in the street?
Yes. And another Warren Buffett is we try to be fearful when others are scared. Oh, I messed up.
We'll get it to everybody later, but the point is, you have to act against your emotions sometimes, which is why you need to have a financial plan. All right, opportunity number 2 is tax loss harvesting, taking advantage of your stock losses. Can you explain how this works?
Yeah, this is more for your non-IRA accounts, but there's going to be positions in there that you may have a big gain in. Even though we're in a down market, those positions are still way up from 2-3 years ago, and you can sell the gains and sell something that's lost to cancel it out so that you're not paying taxes, rebalance your portfolio, and get back into positions that are more ideal for current times.
And I looked it up. Be greedy when others are fearful, and fearful when others are greedy.
Correct.
There we go. All right. Next, explain why a Roth conversion makes more sense in a negative market.
Yeah, the reason why a Roth conversion makes more sense in a negative market is because you're converting more shares per dollar. So essentially, you're taking, when the market's down, you're going to reposition that into a Roth, and it's going to cause you less tax dollars, But then when the market rebounds, you're going to make all of that growth tax-free. So you're going to get the rebound, plus you're not going to owe taxes on that rebound. And it really magnifies the performance of the Roth and the tax-free value.
Mm-hmm. Well, Josh, it's nice to talk this through to recognize that there really are some opportunities, some silver linings in our down portfolio. So if somebody wants to talk through these strategies with you, how can they get a hold of you?
Yeah, they can call us at the office at 260-488-8300 or jump on the web at millardfg.com.
Great. Josh, thank you for your time today. I appreciate it.
Thanks.